welcome to the Property Wealth Podcast. I'm so glad you're joining us today.
Yeah, it's great to have you here. You know, with the ever-evolving landscape of real estate investing, it's important to stay ahead of the curve, right?
Exactly. And one of the hottest topics right now is using AI tools for real estate analysis.
Absolutely. It's fascinating how technology is changing the way we invest.
So, whether you're a seasoned investor or just starting out, there's something here for everyone. We'll dive into how AI can help you make better investment decisions, identify opportunities, and even save time.
And we'll also chat about some practical tips on integrating these tools into your current strategy. You know, it's not just about the tech, but how we can use it effectively.
Right. Plus, we'll share some real-life examples so you can really see how it all comes together.
So, if you're curious about enhancing your investment game with AI, stay tuned.
Let's get right into it. So, Mike, can you start by explaining what AI tools are out there for real estate analysis and how they're being used by investors today?
You know, Sarah, it's really interesting how real estate investing has evolved, especially with everything going on in the economy today. For folks over 40, it's not just about building wealth anymore. It's about securing a stable future.
Absolutely, Mike. I think a lot of listeners might feel that urgency. You know, with retirement timelines closing in, people are increasingly aware of the need for financial security.
Right, and with inflation being what it is, investing in real estate can provide a solid hedge. I mean, property values tend to rise over time, which can really help protect against inflation.
Yeah, I've heard so many stories from investors who've seen their properties appreciate significantly, even when the market has its ups and downs. Like, I spoke with a listener just last week who bought a rental property in a suburb, and despite some initial doubts, he's now seeing a really nice return.
That's a great example. It's all about long-term vision, isn't it? Many people over 40 may be thinking about leaving a legacy for their family too.
For sure, it's like they want to ensure their kids have that financial cushion, right? I met a woman who invested in a couple of duplexes. She told me, I want my kids to have a head start.
That emotional aspect can't be overlooked. It's not just numbers on a spreadsheet. It's about peace of mind, knowing you're doing something that supports your family's future.
Exactly. And when you talk about market shifts, that's where understanding data can really help. Like with AI tools today, you can analyze trends and predict market movements better than ever.
Right. I mean, remember the last recession? Many people were caught off guard because they didn't have the right information at their fingertips. But now, with AI, you can see things coming.
So true. I think it's empowering for investors to have that data available. It's not just about buying a property anymore. It's about making informed decisions.
Yes, and that's crucial for someone over 40 who might be looking at their final investment moves or planning for retirement. They want to know their choices are sound, right?
Definitely. And it's not just about the numbers either. I had a friend who was nervous about investing in a new area, but using AI tools, she was able to see demographic shifts and rental demand forecasts. It made her feel more confident in her decision.
That's a perfect example. It's about removing the guesswork. When you have data showing that a neighborhood is on the rise, that can be a game changer.
And let's not forget about the emotional side of it either. Investing in real estate can create a sense of stability. I mean, for many people, their home is their biggest asset, and knowing it's appreciating can relieve a lot of stress.
Right, and this is especially important as we age. The thought of having a stable asset can bring peace of mind, knowing you have something to fall back on.
And with the current economic trends, we see rising interest rates and fluctuating markets. For people over 40, it's about being strategic, not reactive.
Absolutely. You need to think, how can I leverage these shifts to my advantage? Instead of feeling overwhelmed, they can take a proactive approach.
That's a great point. I think many might feel stuck or intimidated by the market changes, but with the right tools and mindset, they can navigate it successfully.
Exactly. I had a client who was worried about rising costs. She used AI tools to analyze potential investment properties and found an undervalued area that had great potential.
That's inspiring. It shows how even amidst uncertainty, there are opportunities if you know where to look.
Right, and that's really key for listeners. Being adaptable and using technology to your advantage can make a huge difference in your investment journey.
And let's not forget about the wealth transfer aspect. Many people are thinking about how to best pass on their assets to the next generation.
Yes, it's all about planning ahead. Real estate can be a fantastic way to build that nest egg. Plus, the next generation can learn valuable lessons through managing property.
That's so true. It's like a family legacy that can offer not just financial security, but also teach responsibility and investment skills.
Exactly. And for people over 40, this isn't just about financial matters. It's about creating a legacy that your family can be proud of.
And let's be real. The emotional satisfaction of knowing you're setting your family up for success is immense. It's about more than just money.
Right. And as we look at how to implement these strategies, it's crucial to remember that the landscape is always changing, and staying informed is key.
Exactly. So how can our listeners take that first step? What are some core strategies they can start to consider, especially with AI tools at their disposal?
So let's dive into some practical strategies, shall we? I think one of the simplest and most effective rules of thumb for real estate investing is the 1% rule.
Oh yeah, the 1% rule? That's a good starting point. Can you break it down for our listeners who might not be familiar with it?
Sure. The 1% rule suggests that a property should generate at least 1% of its purchase price in monthly rental income. So if you buy a property for, say, $200,000, you'd want to see it renting for at least $2,000 a month.
Got it. That's a straightforward way to quickly gauge whether a property could be a good investment. But of course, it's not the only metric to consider, right?
Exactly. It's a quick check, but you also need to look at other factors. Like, for instance, the 50% rule, which states that about 50% of your gross rental income will go towards expenses, including maintenance, property management, and vacancies.
So if we stick to that example of a $200,000 property renting for $2,000 a month, that would mean I should budget about $1,000 a month for expenses.
Right. So out of that $2,000, you'd be left with around $1,000 before your mortgage payment and any other costs. That's a crucial piece of the puzzle.
And once you factor in the mortgage payment, you'll see if there's any cash flow left over.
Exactly. And that's where cap rates come into play. The cap rate, or capitalization rate, gives you a snapshot of a property's profitability. It's calculated by taking the net operating income and dividing it by the property's purchase price.
So if that same property had a net operating income of, let's say, $12,000 a year?
Then you divide that by the purchase price of $200,000. That gives you a cap rate of 6%.
Ah, that makes sense. A higher cap rate generally indicates a better return on investment, right?
Yes, but it's also important to consider the market. A 6% cap rate might be great in one area, but not so much in another.
Right. Context is key. So what about financing options? That can be a bit tricky for people, especially if they're new to investing.
Yeah, financing can definitely vary. Many investors start with conventional loans, but there are also options like FHA loans for owner-occupied properties. And don't forget about hard money loans, which can be useful for flipping houses.
How does a hard money loan work?
Well, hard money loans are typically short-term loans secured by real estate. They're often easier to qualify for, but they come with higher interest rates. So they're usually best for quick flips rather than long-term holds.
That makes sense. And what about other property types? Are there any specific types of properties that you think work best for folks over 40 looking to invest?
Multifamily properties are often a great choice. They provide multiple income streams, which can be really helpful for cash flow. Plus, they tend to appreciate well over time.
And what about single-family homes? Are they still a good option?
Absolutely. Single-family homes can be a great entry point, especially if you're looking to build equity over time. Just remember to consider the local market conditions and rental demand.
Speaking of markets, how do you evaluate which markets are worth investing in?
Good question. Start by looking at population growth, job opportunities, and economic stability. Areas with a growing job market typically attract more renters, which can lead to higher demand and rental prices.
So it's all about doing your homework, right?
Exactly. You can use tools like Zillow, Realtor.com, and even local government websites to gather data. And don't underestimate the power of networking with local real estate groups or attending meetups.
That's a fantastic tip. So once you've identified a potential property, what's your checklist for evaluating it?
First, I'd recommend visiting the property in person. Look for any visible repairs needed, the general condition, and the neighborhood dynamics. Then, run the numbers. Calculate the potential cash flow based on your purchase price, financing, and estimated expenses.
And what about the inspection?
Definitely get a professional inspection. It can reveal issues you might not notice during your visit, like plumbing or electrical problems.
That's really important. So, once you've done all that, what's the next step?
If everything checks out, you can move forward with making an offer. Just be sure to leave room for negotiation. Sometimes sellers are open to lowering their price.
So it sounds like being prepared and having a clear strategy can really help, right?
Absolutely. And remember, it's essential to stay patient. Real estate is a long-term game, and rushing into a decision can lead to mistakes.
That's a great point. And what are some common pitfalls you see investors falling into?
Well, one of the biggest mistakes is underestimating expenses. Many new investors focus solely on the purchase price and projected rent without considering ongoing costs.
Like maintenance and property management fees, right?
Exactly. And then there's the mistake of over-leveraging. It's tempting to take on as much debt as possible to maximize your investments, but if the market shifts, you could find yourself in a tough spot.
Those are really important considerations. It's all about balancing risk and reward, isn't it?
Yes, and having a solid plan can help you navigate those risks effectively.
Well, it seems like we've covered a lot of ground today. I hope our listeners feel more equipped with practical strategies to dive into real estate investing.
So, one of the biggest pitfalls I see investors falling into is over-leveraging. They get so excited about buying property, they stretch themselves too thin with debt.
Yeah, I can see how that would happen. It's easy to get caught up in the excitement of potential returns, right?
Exactly. I once worked with a client who, he had great intentions, but bought several properties all at once, using high leverage loans. At first, it seemed fine, but then the market shifted and suddenly he was facing cash flow issues.
Oh no, that sounds stressful. What happened next?
Well, he wasn't able to cover all the mortgage payments, and he ended up having to sell one of the properties at a loss. It was a tough lesson for him. The key here is to really understand your financial limits before diving in.
That makes sense. So it's about finding that balance, huh?
Exactly. And speaking of balance, another common mistake is ignoring cash flow. Some investors focus solely on property appreciation or the glamour of flipping houses, but cash flow is crucial for long-term sustainability.
Right. If you're not bringing in positive cash flow, you can end up in a tight spot, can't you?
Absolutely. I've seen it happen. There was another investor I knew who bought a property in a desirable area, thinking the value would just skyrocket. But the rent they could charge barely covered the mortgage, and they didn't have a financial cushion to make up the difference.
That's tough. So, what can investors do to avoid that?
Well, it's about doing your homework. Look at the rental market in the area, factor in all costs, and, make sure your monthly income can cover your expenses with some room to spare.
Speaking of expenses, I imagine hidden costs can really catch people off guard too, right?
Oh, for sure. Many new investors underestimate things like maintenance, property taxes, and even HOA fees. I once had a client who purchased a condo, thinking it would be a low-maintenance investment. But then, out of nowhere, the HOA raised the fees significantly, and she was left scrambling to make ends meet.
That's frustrating. It's like those little costs just sneak up on you.
Exactly. And that's why it's essential to do a thorough analysis before investing. Look for red flags, like properties that seem too cheap, or areas with a lot of vacancies. If something feels off, it probably is.
So it's really about being diligent and not letting emotions cloud your judgment.
You got it. Another big mistake I see is trying to time the market. Some investors think they can predict when prices will go up or down and wait for the perfect moment to jump in.
Yeah, that's a slippery slope, isn't it?
It really is. I had one investor who waited for 2 years, convinced that prices would drop. Meanwhile, they missed out on several great opportunities. When they finally decided to buy, prices had shot up, and they ended up overpaying.
That's a tough lesson. So what's the best approach then?
Well, the best strategy is to invest consistently over time, rather than trying to time the market. Focus on finding properties that fit your investment criteria and your financial goals, irrespective of market fluctuations.
That's a smart way to think about it. So you're saying it's more about the long-term vision than chasing short-term gain?
Exactly. And another thing to keep in mind is the importance of screening tenants. Bad tenants can turn a promising investment into a nightmare.
I can only imagine. What kinds of issues have you seen?
I once had a client who skipped the tenant screening process. They found someone who seemed nice but didn't check their background or rental history. Within a month, they were dealing with unpaid rent and property damage.
Oh, wow, that's a tough situation.
Yeah, it was. They ended up having to evict the tenant, which took time and money, so it's crucial to have a solid screening process in place. Check references, credit history, and even do a little background research.
So it's like doing your due diligence on the tenants, just like you would on the property itself.
Exactly right. And if something feels off during the screening process, trust your instincts. Don't rush into a decision just because you need to fill the vacancy.
That's such a good point. So if investors find themselves in one of these situations, what can they do to recover or avoid these pitfalls in the future?
Well, first and foremost, educate yourself. Take the time to learn about real estate investing, cash flow, and market trends. And don't be afraid to ask for help from experienced investors or professionals in the field.
That's a great tip. Surrounding yourself with the right people can make a huge difference.
Absolutely. And if you find yourself in a tough spot, don't panic. Evaluate your options and, if necessary, consider bringing in a property manager or a real estate advisor to help guide you through the process.
That's sound advice. So the key takeaway is to stay informed, be prepared, and don't rush into decisions based on emotions.
Exactly. Real estate investing can be incredibly rewarding, but it requires careful planning and a clear strategy. It's all about building a solid foundation for long-term wealth.
Well, that's a perfect way to wrap up this discussion. It's all about learning from the past to pave the way for future success.
Definitely. And remember, every mistake is a learning opportunity. Just keep moving forward. You know, Sarah, when it comes to taking those first steps into using AI tools for real estate analysis, it can feel a bit overwhelming. But really, it doesn't have to be.
Absolutely, Mike. There are so many resources out there that can help you get started right away.
Right. Let's break this down into some immediate, actionable steps that anyone can take, starting today. First off, I'd say, get familiar with online platforms like Zillow or Redfin. They're not just for looking at houses, you know?
Yeah, they're great for analyzing market trends, right? You can see what properties are selling for in your area, and even get a sense of how long they're on the market.
Exactly. Also, consider using tools like Rentometer. It's fantastic for quickly checking rental prices in specific neighborhoods. You just plug in the address, and it gives you a good idea of what similar properties are renting for.
That's super useful. And then there's Bigger Pockets, right? They have calculators that can help you evaluate potential deals.
Yes, the Bigger Pockets calculator is a must-have. It can help you analyze cash flow, ROI, all those important numbers that help you make informed decisions.
And if you want something even more in-depth, DealCheck is another great tool. It offers robust property analysis features, and you can even analyze multiple properties at once.
Yeah, and if you have access to a local MLS, that's like having the key to a treasure chest of information. You can get detailed insights into properties that aren't available on public platforms.
That's a good point. Plus, for those who are just starting out, I recommend setting a goal of analyzing one deal per week.
Exactly. It's all about building that habit. Even if it's just a quick analysis, getting into the rhythm will make it easier over time.
And don't forget about local meetups or online communities. Engaging with others can provide support and insight that you might not get just by working alone.
Definitely. Surrounding yourself with like-minded investors can keep you motivated and help you learn from each other's successes and mistakes.
And for those who enjoy reading, there are some fantastic books out there. The book on rental property investing by Brandon Turner is one I always recommend.
That's a solid choice. Also, Real Estate Investing for Dummies is a great resource if you want a comprehensive overview.
Oh, and there are podcasts too. I love listening to Bigger Pockets podcast when I'm out for a walk. It's filled with real stories and actionable tips.
Yeah, podcasts are a great way to learn on the go. You can get inspired by different investors' stories and strategies.
Right, and speaking of habits, starting small can make a huge difference. Even if you can only dedicate a bit of time each week to research or analysis, it's a step forward.
Absolutely. You could also keep a journal of your findings, noting what you learn from each deal you analyze. It'll help you track your progress and refine your approach.
That's a great idea. And as you get more comfortable, you can start diving deeper into the data and trends in your market.
Yes, and remember, it's about starting where you are. You don't need to know everything right away. Just take those small steps and you'll build your confidence over time.
Exactly, and each step you take makes you more prepared for bigger opportunities down the road.
So with these tools and habits in your pocket, you're really ready to move forward. Let's recap what we've covered today. Well, Sarah, as we wrap up this episode, I think we really highlighted some crucial points about using AI tools for real estate analysis.
Absolutely, Mike. One of the big takeaways is how these tools can save you time and help you make more informed decisions. I mean, it's all about working smarter, not harder, right?
Exactly. And we also talked about how they can provide insights into market trends, which is vital for any investor looking to get ahead.
Right. And let's not forget about the importance of data accuracy. Using AI tools can help reduce human error, so you're basing your decisions on solid information.
Yeah, and that gives you more confidence when you're making those big investment choices. It's like having your own personal analyst at your fingertips.
And lastly, we touched on how accessible these tools are, even for folks who might not be tech savvy. It's really about empowering everyone to take charge of their investment journey.
Exactly, Sarah. It's an exciting time to be in real estate, with technology making it easier to build wealth.
You know, if you're over 40 and thinking about diving into property investing, now's the perfect time to start. Remember, every small step counts towards building that long-term wealth.
For sure. And if you found today's episode helpful, we'd love for you to like this video, subscribe to our channel, and drop a comment about your biggest takeaway or any questions you might have.
And don't forget to share this episode with someone you know who's also interested in investing in property.
Next time, we're going to dive into prop tech apps every investor needs.
That's going to be a great one. So until then, keep exploring, keep learning,
and keep investing wisely.
Bye for now.
Take care.